Chris, I'm going to mostly be on, are we live yet, Sue?
It takes a few seconds. Yeah, so not yet.
I have COVID, so I'm losing my voice.
Okay.
So I will try to chime in, but if I'm a little bit, give me a second to get off mute when we can, because I apologize.
Okay. Well, I'll be praying for you that you okay.
Thank you. I appreciate it.
Yes, I'm sorry to hear that. Get well
Can't
soon.
lose you.
Sure.
Oh, I know. I'm hanging in there.
Good. Oh.
Okay, we are live.
Okay.
Thank you, everyone, for joining today's call for the investment meeting. Sue, can I get a roll call for attendance, please?
Sure. Angela Banks,
Here.
Christina Bennett,
Present.
Joseph Clark, Darnetta Klingscale.
She on mute.
I think
Present.
she dropped off, so we'll see if she comes back. Sheila Goodwin,
Sheila, you're on mute. She's on. She just
Yeah.
on mute.
can you wave, Sheila?
I'm sorry, I'm here.
Okay, all
There
right.
you go.
Donna Jones,
I'm here, but my connection keeps going in and out.
Okay. Donna, call me if it does, and I'll just put it on so you can see. Okay.
Okay, all right, thank you.
all right.
Mhm.
Yvette Levy, Bobby Richardson,
Here.
Albert Sanders. Okay, Darnetta's, and Justin Stein.
Here.
Okay, and Darnetta's coming back. So Darnetta, we called roll. So you're back, you're here. All right. So we have 8, so we do have a quorum.
Thank you. First, I'd like to go over and have our consultant, NEPC, Kristen, if you would like to take over, and you can choose the order of our recommendation or our flash, whichever you would like to proceed with for today's meeting.
Sure. Thanks so much, Christina. What I think I'd like to first start off with is the recommendation for the real estate. I think we've been doing a lot with the performance, and so it's just a quick update. So let's maybe start with that. Suze, do you want to put your screen, or you want me to
Yeah.
do it?
I'll-
Okay.
I'll get it up.
Okay.
All right. Let's see, which this one? Okay,
Okay, great. And maybe if you could advance the slide for me. So I just wanted to remind you what we're doing here today. This is sort of an executive summary slash recommendation. Just as a reminder, first off, this is a re-up. And so, as you know, we've moved into the private real estate market. Your first 2 investments were with Elm Tree, which is what we're going to be talking about today, as well as Basis. And so with that in mind, as a reminder, we have a 7% target to private real estate. We won't achieve that for a number of years, 2025. The reason is because these are drawdown structures. What does that mean? It means once we commit, and I'm just going to use a round number of 10 million as an example. After we commit that, the manager then determines when they're going to actually draw that capital down. So that capital, that 10 million does not leave your portfolio. That 10 million stays in your portfolio until Sue gets a letter and says, hi, we need $1 million. And then she will rebalance out and raise $1 million and send it over to them. And so they really match that with the actual when they have an investment. And then, of course, as you know, the duration time in which you're in the investment is a much longer period of time. So these tend to be anywhere from 7 to 11 years, I would say. However, Greenspring was able to really make some realizations pretty quickly for us. So that just gives you a perspective of what the program looks like. Right now, we have about 1.3%. So you see, we're trying to get to the 7% target. So it's going to take us multiple years to get there. Also, we don't want to dump it all into the market at one time because we want to have what we call vintage year diversification. Vintage year is going to be the year in which you invest. So the closing of the fund, or when you actually invest, if it's 2020, then that would be a 2020 vintage year. If it's 2021, it would be a 2021 vintage year. So that just gives you perspective. Right now, we have about $15 million allocated to private real assets for the upcoming 2021 year. As remember, we spent a decent amount of time, a great deal of time going through the pacing plans. At this point, because it's a re-up and because we have high conviction in it, we are recommending that St. Louis consider Elm Tree, their Fund 4. So we were in Fund 3, but their Fund 4 for an upcoming investment. This again, it's a triple net lease. Oh, you know what? Let me stop before I move forward. Because they sold and had a realization early on within several years, to give you perspective of how well they did for you, you netted 39.99% internal rate of return thus far. I don't necessarily expect this Fund 4 to do that exact thing. I mean, there is, you know, a lot of skill, but a little bit of luck in there as well. But we do feel that this is a solid team and that they should be able to add value to the portfolio. But again, you know, 40% is, you know, they knocked the cover off the ball. Just to go back, what are they actually doing? They're doing what we call triple net lease. They have a long track record. The net lease market has gone from right around, I think, about 15 to 20 billion, I'm sorry, up to now about 63 billion over the last 10 years. So they've been able to ride that wave, if you will, and have real expertise in this space. So they have a competitive advantage. Sue, maybe you can move on. And I'll ask if you have any questions. I should probably stop. Okay. Well, as I mentioned, strong performance. You know what they did for your fund, but just to give perspective over all of their funds, you can see that they are high double digits. The other piece that's a benefit for Elm Tree and this particular fund in general is they don't have what we call a legacy portfolio. So because Fund 3 is fully realized, they no longer have any responsibilities to Fund 3. So that means that 100% of their focus is going to be on this fund, Fund 4. And so that's just always a nice thing. Most of the time, managers have to spend maybe 10 or 15% of their time still focused on the fund that they're winding down. But in this case, it's already done. And so 100% of their time is going to be focused on the new fund. And so our recommendation is anywhere between 5 to 7 million. We are anticipating that as the pacing plan outlined, that you will need to look to do sort of non-core or value add, which is what this falls into, as well as real estate debt. And so we do have some managers that will be coming forward in real estate debt. And so anticipate probably 2 managers to fulfill or round out your allocation for 2021. Sue, maybe you can move forward. Okay, I wanted to provide you with the manager profile. A lot of this I've already talked about, but this just gives you perspective again. On the bottom, you'll see what the track record is for the funds, and you see they have strong IRR, that's internal rate of return, that's how we judge it. Their fees are within reason. Their GP commitment is pretty high. It's at least 3% of committed capital. Oftentimes we see 1 or 2%. So that means they're vested in their fund as well. So they're investing alongside you. So that's always a good thing. And then again, what I think is also relevant here is their expected final close is going to be you know, coming up in the first half of the year. So this was another reason we wanted to really get this on the docket so you can consider it. Because if you move forward, we want to have the opportunity for the fund to, for negotiation with the contractor, or the contract negotiation with the attorneys. Any questions? Okay.
So Kristen, can you talk about the fact that this manager is a little bit different than a lot of our private equity ones, is that they usually call capital immediately when they have an acquisition and they deploy it, and we start seeing return a little bit different than we do on most private equities. This one, they return capital as they realize it because their tenants are paying principal and income every single month.
Yes, so this has an income component to it, which triple net lease, as the name suggests. And Christina's right. So I gave you kind of a range of 6 to 11 years, typically for private equity or private markets, let me say, because this is private real estate. But in these, oftentimes in these types of strategies, this triple net lease, or when you see real estate debt or even private debt, they often have what we call a narrow or shallow, a shallow J curve. And that means that you invest, they call the capital a little sooner, and they start to have realizations, and oftentimes, not just realizations, but they throw off income. And so all of that helps to mitigate that J curve, because typical private equity, and if you remember when we had the education on it, you invest and then you dip like a J because your money hasn't been realized, you're not getting anything from it, and you're paying fees. So you go down and then you have a sharp upturn as you start to have realizations, and the fees remain there, but again, they're not having as much of an impact because you're getting the realizations back. So that's what we call the J curve. In these type of situations, the J curve is not going to be a deep J, it's going to be a very shallow J, if you will, if at all. And I actually think the Elm Tree 3 did not have much of a J curve at all, because like I said, their fund was purchased and they realized almost 40% fairly quickly. So.
Kristen, I have a question.
Sure.
You said that with this fund, the fees are reasonable.
Yes,
Where are the fees? Are they on this chart?
they are. So if you look on the right-hand side of it, I guess the third box on the top, it says GP fees, promote, and commitment. And so the fees are articulated a little bit different. So they have a preferred return. That preferred return means that they don't get any fees until you get 7% of your return. Okay. Then they have a 20% carry interest with a 50% catch up. So they get 20%. And then after that, they'll get 50% until they've caught up, because remember, they weren't getting fees for a period until you got a certain return. So it's a nice structure from that standpoint. So that's where the fees are.
Okay. 1.5% is what the fee is, the percentage?
Yes. Oh, wait, no, that's 15%. That's the target net RR. It's a 20% carry interest. Oh, yes, and then 1.5 management fee. And I apologize, the management fee is constantly paid, but they have a profit sharing kicker, which is what I just explained to you.
Okay.
I have a question.
Yes.
Okay, you said the vintage year is when we invest, right?
Yes. Yes.
So on the fund name, Elm Tree US Net Lease Fund 3, the last time we invest was in 2016?
Yes, that was a 2016 vintage. Yes.
So in 4 years, we haven't invested anything in Elm Tree?
No, because it's you once the fund. Well, okay, let me take a step back here. Once you commit, we haven't committed anymore to Elm Tree. We make whatever our commitment is. And Elm Tree, I think it was, I feel like it was 10 million, maybe not, maybe 5 million. I don't know. It's not popping off my memory bank right now. I think it was 5 million.
I think our initial investment was 8 million.
Was it 8?
Maybe.
Thank you.
And yeah.
Yeah,
Okay, thank you. I just didn't
8 million.
remember.
Yeah, 8 million.
Thank you. Thank you. I knew it wasn't quite 10. So, okay. So what we do is we make a commitment. Once we make the commitment, as I mentioned, those assets don't immediately leave your portfolio as with a public market manager. They stay in your portfolio until the manager comes up with ideas that they want to utilize. As Christina highlighted, in the triple net lease, they do come up with those ideas a little quicker, and so they'll call the capital. But they really are calling the capital on an as-needed basis versus it's sitting in an account waiting to be invested on their end. Okay. And so these are closed in funds, so they're not something that you're trading in and out on a regular basis.
Yeah, it
Okay.
looks
So
like
Chris,
we've
Chris,
committed 5.5 million so far.
right. So Bobby, so for example, it's kind of like we told them in 2016 we were going to give them $8 million. And they only in 2016, like from 2016, maybe 17 and 18, they only asked us for 5 million of the 8 million. And out of that 5 million that we paid into, like whenever they asked us to, right? We have received almost a 40% return on the money that we invested. So not only did we get a return, they started paying us as soon as we started investing. So it's kind of like we tell them we're going to give you 10 million, and you decide when in the next 5 years when you're going to need that money. And when they need it, that's when Sue, or let's say Andrew, found cash in our portfolio to give it to them. So that 2016 was an original. We approved it, and that's when they had the right to ask money. If we approve it in 2021 for whatever amount, then they have the right for the next 5 years to tell us what they need and when they need it.
Okay, I was just looking at it, and I was trying to read ahead, and I was like, 2016 was the last time we invest, so I didn't understand that. So thank you. Okay, got it.
Okay. So at this point, I think that, are there any questions here? Okay, so this is really concludes it. So really the recommendation that would need to be approved, I think at this point, is 5 to 7 million for going towards Elm Tree's triple net lease fund 4.
I'd like to make a motion that we commit $5 million to the Elm Tree. What is it again? The triple?
Fund 4.
What? I'm sorry.
Just
Either-
Elm Tree Net Lease Fund 4.
Oh, Elm Tree Net Lease 4 Fund. Net Lease 4 Fund.
Fund 4.
Fund 4.
I
It's a tongue
second.
twister.
I second.
All right. Angie Banks,
Yes.
Christina Bennett,
Yes.
Darnetta Clinkscale,
Yes.
Lewis Cross,
Yes.
Sheila Goodwin.
Sheila, you need to take your mute off. Sheila?
Yes, sorry about that.
That's okay.
Okay.
Donna Jones,
Yes.
Bobby Richardson,
Yes.
and Albert Sanders,
Abstain.
and Justin Stein.
Yes.
Okay, so we have 1, 2, 3, 4, 5, 6. We have 8 yeses and 1 abstention.
Great, thank you. Motion carries. So Sue, will you notify Elm Tree of our decision and start the paperwork on that process for legal documents?
We will also have to bring
Once-
it to the.
Oh, we
board-
have to bring it to the general board,
Yeah.
sorry.
The board meeting next
Yeah,
month.
next week, okay.
Yeah.
Okay. So I think then we can just talk quickly. This is a pretty succinct meeting here today on the flash. Just review the flash. Hi, Albert.
Hello.
Okay, maybe you can, yeah. Move here. So what you can see on the top line, your composite gross fund size now is right at 897 million, little over 897 million, 357, 280. So you have, again, had additional gains. Your 1 month and 3 month did beat the benchmark. Your 1 year, 7 year, 5 years seem to be trailing a little bit. And again, there's a couple of high level reasons why. Value has not done as well as growth. And so your value managers have trailed. Now they've added value or they've added returns to the portfolio. So I don't want you to think that they were negative. It's just they didn't keep up with the benchmark. The benchmark has been very, very, well, the value has not done as well as growth. And then the growth benchmark has been very, very strong. So with that in mind, that causes you to have a little bit of difficulty keeping up with the benchmark. So maybe if you want to take a step, or Sue, your screen is a little bit in the way here, but if you can see where you may have had some, I don't want to call them hiccups, but areas that didn't do as well. In particular, when you scroll down your domestic equity and you see, again, the 1 month, 3 month, we've had robust returns. 3 months was 18.2%, so very strong returns. But then when you look at the 1 year and 3 year, 1 year is at 15%, which again is very strong, I might add, but it didn't keep up with the benchmark. And so that's what I mean when I say that the markets had a different, the active managers had a difficult time keeping up with the benchmark. Really, if you scroll down and you look to your value, Edgar Lomax, definitely struggled on the 1 year number. As you can see, they had a negative 5.7%. But I have to tell you, Lomax has been one of your high performing managers for several years. And so it's not unexpected that at points they will have some points of trailing. And so we don't feel that they have lost any of their investment acumen. Their processes are still strong. They're still sticking to their knitting. And so we're very comfortable with where they are. But I just wanted to highlight that because you do see a negative number there. When you move down to your growth, this is where you're going to see your managers not quite keep up with, in some cases, with the managers. If you look at that 1 year number and you look at your Intech, you see Intech had 35.7% return in 1 year. That is beyond outstanding. But it was trailing the index of 38.5. So again, while you see the numbers and you see that you may have been trailing on the policy index standpoint a little bit, I want you to see the forest through the trees here that 35.7% is really an outstanding number. It's not something that we think is going to be sustainable over the long term, but you know what? It's posted and we're going to take it. And so you see that as well with TCW. They did beat the benchmark by a couple of basis points, but again, the benchmark, when you see your quarterly, which will be in February, you will see that the benchmark is in the top decile during those periods. We will typically expect the benchmark to be in the 50th percentile, so right at the median. Again, just giving you some perspective.
Kristen, I also want to mention that we have to, when we look at numbers, we have to look at the perspective of what happened in 2020. So while we're looking at these numbers, we also have to think that March, January through March, our pandemic hit. And then we had the effects of the pandemic even a little bit more from March to June. So while these numbers are great, they're phenomenal when it probably comes to the second half of the year, but everybody got hit in the first quarter. And so therefore our 1 year, we won't see a change until maybe March or June of this year to show what a 12 months looks like. So I just wanted everybody to remember when we're looking at these, we also are looking at these numbers with the pandemic in our rearview mirror.
Yeah, no, absolutely. That's a great point. So maybe we can move forward. Again, small cap did well also, as you can see. you know, your 3-month and 1-year time horizons, again, strong performance, but that benchmark was doing even better. So, you know, in particular, growth did very well. Look at that Russell 2000 growth. That's supposed to be the 50th percentile, and it's at 34.6. Westfield did do a little bit better at 39.6, but again, you know, it's just not ideal as it relates to where we would normally expect the benchmark to be. Then you have systematic financial management. So I really want you to see the difference here when you look at that 1-year number between the value and the growth equity. So you got, you know, 34, 39% for the growth, and then you're talking about single digits. So there's definitely been a disparity. However, when you move into the 3-month period, you now start to see where value is coming back. So you see that the Russell 2000 value for the 3-month was at 33.4%. Now, we don't know yet if that's going to be fully sustainable, but it does show that there could be some reversion to the mean coming forward. You have both in your portfolio, so that means you'll have exposures to both, and that's really how we built the portfolio, because we do know that different styles are going to do well in different time horizons. When we jump down to the non-US, you can see in the 3-month, once again, non-US did very well. Fidelity and Causeway were your two managers. Causeway came back like a champ at 27% in your 3-month time horizon. They also are a value manager. See the comparison to that 1-year number at 6%. So there's just a bit of a trend. We're watching all of this. I'm just sharing this as additional information so you continue to understand how managers are volatile, how they do vacillate in their returns, and how we do sometimes see macro themes playing out. Moving down to EME, or emerging market equity, definitely added value to the portfolio. DFA and Invesco both posted strong results in the 3-month, as well as Invesco did very well in the 1 year. I would say DFA did trail. Again, they are a value manager, but they trailed probably a little more than I would have expected. The benchmark did extraordinarily well during that time period. But I want to add, the benchmark has growth managers in there as well. So it's not a pure value EME portfolio or benchmark as you would see in some of the other areas. Okay, we can move on, please. Great. And now we're just looking at your global equity, which is going to be a combination. And again, strong results. 1 year's 13.6 versus 15.9. Trailed a little bit, but remember, we still had legacy progress managers. So there was some changes that were put in place over the last year. But again, they're doing what they're supposed to do, so we don't have any concerns here. We can move on to fixed income. When you look at your fixed income, of course, the performance is pretty dismal. Nice to see that 1 year at 8.6%. We've just come out with our expectations, so we have a pretty low expected return over the next 10 years for fixed income. So glad we're getting it now, because I think, and actually the fact that the markets are doing so well actually means that going forward, they won't do as well. We've kind of robbed a little bit from the future. But that said, your 1 year and your core fixed income, very strong. Manulife did very well. Earnest and then Exponents, which we didn't do as well. I will highlight, though, that Exponents was one of your #1 managers for several years, probably for about 4 years. They were ranked 1. So again, everybody has their day in the sun. When you move to absolute fixed income, absolute return fixed income, Loomis Sayles, outstanding job in the 1 year. You see there at 11.4%. So they just did a phenomenal job. And you know, you can see that it was a little bit of an outlier during that period of time. So I don't expect them to be posting those type of returns consistently, but it's a nice bump to the portfolio. And then as you scroll down, TIPS did well also. And then global multi-sector, that had some of the other areas that didn't do as well. You have Neuberger Berman there, still did 5.2% and then 5.9%. but that's going to be a combination. They're going to have EME, they're going to have, EM debt, emerging market debt. They're going to have some core, some tips, some high yield. They're going to have a lot of different things in there, so which we know. And then your EMD blended did very well at 8.5%. So, and again, I'm looking at that 1 year number because it's a bit longer to give us perspective. Okay, we can move on. All right, and so we can end up here with our GAA. Once again, go anywhere type of portfolio. We brought that percentage down. It's now at 5.6%. If you remember, we had gotten close to 12% in GAA, but just determined that there were other areas within the portfolio that we were getting the exposures that are that we see in GAA. So we just didn't feel that we needed quite such a large allocation. But again, a blended portfolio. And we'll revisit whether we actually need 3 managers or not. That's, you know, something to be determined or reconfirmed, but just at least asking the question. As we move down to hedge funds, for the 1 year, 10.1%, I think that's really great returns, given that, you know, this is a diversifier. This is a cushion on your portfolio. It's not going to be the high flying area, but again, Grosvenor did well at 17%. Entrust is really winding down. That's why you see such a negative number there. And if you look, it's reflected on the dollar amount. They only have 1.5 million. So, you know, we're trying to look, close that one down. And then of course we have White Box and then Grosvenor. Okay.
So Kristen, overall, because I can't see on my little phone screen, what did we tentatively report as a year-end return on the total portfolio?
Oh, you know, Sue would have to go, well, I
Go
mean,
back to that main page.
yeah, otherwise, 10%.
That's great.
It is. So it's but well above your expected return. In 3 years, it's even at a 7.1%. So.
Okay, thank you. That's one of the numbers I was looking at, and I'm squinting on my phone here.
No worries.
But that's going to be good for us and our 5-year experience. That it occurs this year, correct, Sue?
I'm not sure if it's this coming up year or not.
Okay.
So
Does
the remaining.
anyone?
Oh, I'm sorry.
I just had anybody else had any questions on the portfolio? Flash.
Mhm.
You have anything else, Kristen?
No, that pretty much covers it. I think that the portfolio is doing really well. So
Can you let us know what we have planned for our February meeting? We have
I
a
thought,
training and we have something else.
yes, I was thinking that we could look at private credit and potentially also looking, well, we can do both, maybe private credit and private equity. And what I'd like to do, there's a manager, Crahill, that I've mentioned a couple of times, very strong manager that I'd like you all to consider. It also has, it's a minority, it's a Latino manager. So I just think that it would fit very nicely. The complexity around it, it would work well with your current manager, MC Credit in Monroe and Brightwood. And so I thought it'd be a nice additive to the portfolio. And then of course, we're going to be looking at private equity fund of funds as well.
Okay.
So I'll be working with Eric Harnish to see exactly, you know, where and what we are going to do. But needless to say, in a minimum, we'll have private credit and hopefully potentially private equity as well. Okay.
Okay. And so if you can work with, refresh my memory, Lewis, is it Darnetta and Sheila on the fixed income training we'll have on February?
That's right, Darnetta. You and Sheila would handle that. Is that right, Sue?
Well, would we
Yes.
want to do it at the investment committee meeting?
Yes.
I think
Yeah,
that
we
would
could,
work.
but I
Yes.
think, yeah. But Sheila and and Darnetta are, that's their committee, I think.
Right. I mean, we've recommended it. If Sue can schedule it, that'll be wonderful.
Okay,
Yeah, I think the gentleman from Exponents is set up and he's ready to go
Okay,
for
Great.
our February investment committee meeting.
excellent.
okay.
Sheila,
Yes,
makes sense to you?
yes, it does.
Okay.
So with that in mind, then maybe what we'll do is just bring one of them forward because that'll be a packed agenda. So,
Correct. Yeah, that will be good.
okay.
Yeah, so that would be February 18th.
Mhm.
February 18th, right?
Have we already looked at our allocation? I don't know, it seems like,
So yeah, so that's gonna be, you know what, that's actually coming up as well. So let me talk with Sue and figure out what we can, because we have that education in February. Maybe I can do sort of a summary version in March, excuse me, in February, and we can move to an allocation, because really, we'll run the asset allocation, but I doubt there's going to be much on the changing. Like, so we know we're going to still be investing in private credit, private equity, and real estate as examples. So with that in mind, I think we want to make sure that we, you know, we're able to take advantage of opportunities as they come forward. So apologize.
And-
I have my
Also, Kristen, can we look at, I know we had reduced GAA. Do we need to
Yes.
reduce it any further? Do we still need that asset class? Because when we invested in that a long time ago, it was our way to be able to get more global exposure. But do we need it? Does it, you know, I know it adds value to our portfolio, but there's what, three managers in there?
Yeah, so
You know, so it's $50 million, but do we, you know, PIMCO, I mean, off the chain, right? They were amazing 10 years ago. They kind of flattened out and they've done well in this last year. But do we still need that 50 million allocation to GAA?
right, so we can review that again. Like I said, last year we did bring that down. And as I mentioned when I was going through the report, at a minimum, even if we leave it at a 5% allocation, I don't believe we need to have 3 managers.
Okay.
So we can probably, I mean, we can either do, I would keep PIMCO, so we could either do PIMCO and GMO, but we definitely don't need Mellon, GMO, and PIMCO. I think
Okay.
that's a little overkill.
And
for
again,
some-
Angie, does that answer your question on allocation of things like that we need to do?
yes, thank you.
So, okay, that concludes my formal remarks.
Great. I don't have anything else on the agenda. Do you, Sue?
That was it.
Okay, if there are no other questions and no other agenda items, can I get a motion to adjourn?
Make
I'd like to make a motion that we adjourn the meeting.
Second,
That's a Sheila second. All those in favor?
aye.
Aye.
Aye. All righty.
All right.
Thank you, everyone, for your time.
All right,
you.
get
Thank
well
you.
soon, Chris. I'll
All
be
right.
checking
Feel
on you.
better. Thank you.
Thank you.
Yeah.
Okay,
Okay.
take care.
Thank you
Bye-bye.
all so much.
All
Okay, bye-bye.
right.
Bye.
Okay, see you in
Sue.
February.
Okay.
All right.